We had a couple of interesting meetings this last week, and we've had this situation over and over again where people are a little bit confused about how to measure their performance because, you see the Dow on TV, you see this S&P 500 on television, and they can use different time frames and beginning and ending periods, and you might hear like up 50% or up 30% or down 20%. And then people can look at their performance reports and go, wait, that doesn't make any sense. How come the Dow is up, X percent over the last, cherry picked time frame that they saw on the news, and we're up only this much, or vice versa. Usually you don't hear about it when it's vice versa, right? If you're down less than when what they're saying. So I, speak to your thoughts on that, JP. I mean, like how, first of all, what is a good way to look at benchmarking for an individual investor? So in other words, what is that measure of success rather than just looking at the Dow or the S&P?
Yeah, it's an interesting topic because I don't think you'll find an asset manager that likes benchmarking overall, right? Because we all do what we do, and we believe we do the best we can, and we don't really compare to some arbitrary benchmark. But that's where the problem is. You still need a way to measure what is success, right? So I'm talking at the broad level. We'll take it down a notch. But basically, every investment strategy has as an objective, right? So an objective as a target return, as well as a target amount of risk that you're willing to take. So whatever benchmark you are comparing that to should be representative of that same of those same objectives, right? So for example, we have very few clients that are 100% invested in equity. So comparing their portfolio to a benchmark that is 100% equity, like the S&P 500, the Dow Jones, or the Russell, pick your favorite, is unfair, right? Because you are comparing apples and oranges. So first, the benchmark that you are comparing should be a reflection of your asset allocation. So how much is the target equity versus fixed income and other asset class in your portfolio? You should have a benchmark that is blended in the same proportion to make it fair, right? So that is certainly the first thing. And then if we go,
hold on.
Yeah.
So
okay.
that's one thing. So representativeness.
Yes.
So what? So that's when you take a CFA, that's one of the things they tell you. What is a benchmark, and how do you know it's a good benchmark? I think that's what you had mentioned. That's partially representativeness, like
at the asset class level. And then,
what you're investing in is what your what the benchmarks are related to exactly what you're invested in, or as close as possible, and that could be, like you said, at the asset class level, but go on further, it could be more detailed too. So, but that's the key, right? Representative
is the key. And then, so look at the overall pie, right? Split. And then you go down and that benchmark should also be representative of the style that of investment that you make, right? If we stick again with equity, because it's more familiar and easier to understand, if an investment strategy focuses on growth type of companies versus value, right? Then you also have to make sure that what you're comparing yourself to is a benchmark that is also representative from that standpoint, that has companies that are focused on the same characteristics, whether it's cheap companies or whether it's high growth companies, and that's an important one, because we have seen, I was running some numbers yesterday, a tremendous variance, a tremendous difference in return just between the growth and value index, right? For example, if you were to look at the past 5 years, I believe the growth index is up 170%. The value is maybe up only 70%, and then the S&P, the 500, or the blend, the overall market, if you don't take into account the style, is somewhere in the middle, right? So it's easy for, if you compare yourself to the wrong benchmark, to either, as an asset manager, to say, I'm a hero, if you take an easy benchmark to beat versus taking, if you correct, or if you take a benchmark that is more, again, representative of this, of your style, then you have a much more fair comparison to say, what is, are you being successful investing in that particular style of companies? So
if you are a style oriented investor,
that's
if you're
correct.
like a value investor, or if you're not, if you're style agnostic, then that may not necessarily be as important, but you still would want to take advantage of other factors like geography or market cap size. And like
Yes.
for us, we look at more of a broad-based, large, mid, and small, kind of an all cap, because we're not constraining ourselves to one area, and we're also not constraining ourselves to growth versus value. So, we have strategies that are both value and growth, but in terms of how we invest overall, it may be, we're really just trying to be where the action is. So if it's more value oriented, we'll have more value. And that's really important. So we got representativeness and style. How about investability? That's another big one that I think is always messed up when people are thinking about benchmarking.
Yeah, it is. It's important to compare yourself to a set of instruments or securities that you could invest in, right? Otherwise, again, it becomes an unfair comparison if you have illiquid type of securities in a benchmark, and therefore you cannot reproduce that benchmark in a true investable portfolio, right? So very important that the portfolio be representative, be investable, and in assets that have enough liquidity that we could invest that. And that's what we see with ETFs, right? So ETF, every exchange traded funds, is based on an index. And that index is representative from that standpoint of liquidity and investability and all those criteria we're talking about.
I agree, because if you even pull up the S&P, you hear this all the time. Most portfolio managers don't beat the S&P 500, and they're usually looking at just the index of S&P 500, which is really that's a figment of the imagination. It's a calculation based on numbers, right, of returns based on prices. But it's actually, if you want to actually look at something that's more representative of what you could invest in my mind, it's actually, take a look at the actual ETFs that follow those benchmarks. Those guys are trying their very best to keep expenses down, and in that, you'll see the impact costs from their trading, and you'll see all that. That is investable. We could put, $1 million in the S&P 500 funds, either a mutual fund or an ETF.
Maybe we can get into a little bit of the weighting, right? Because it's really at the heart of what we do. Is how you there's two decisions you make, right, when you manage money. The first decision is which stocks do you buy, if we talk about equities. That's the selection part, and the second is the portfolio construction, which is how much of it do you buy? Do you buy 20%, 5%, 1%? And that, of course, is a very big factor into determining your performance. Now, if we think about from a benchmark standpoint, benchmarks are come in a couple of flavors from a weighting perspective. Something like the S&P 500 is market cap weighted, meaning the largest company, the Amazons of the world, get the largest weight. And basically, the index weights are a reflection of the size of the company as measured by market cap. And the largest companies become larger, which is what we have seen. We are seeing I think, an unprecedented amount of concentration in the index, because the same companies have been, again, kept going better. And this is your Amazons and your Netflix and then the FANGs and your Apples that came bigger and bigger, and therefore getting a larger and larger portion of the benchmark becoming.
That's a really good point. Sorry to interrupt you there. I think we'd have to look at the data, because if I remember correctly, we've had similar types of concentration, like say in the top 10 holdings in prior times. But I don't know if this is unprecedented, but I know that this has definitely we've been in this range of concentration before, and almost every big move we have this. and then it corrects. But I agree. Maybe this may be the most unprecedented. We'd have to look at the data. But
yeah, it's on the high. I was looking at it, for example. I mean, IT right now, technology is 28% of the index. Almost a third of the index is in one sector. There's 11 sectors. While things like energy is 3% or less of a benchmark. So you got to look at, how representative is that from the actual moat of those industries in the broad economy.
Do we know what technology was at the dot-com bubble peak?
No, those weights, that certainly would be an interesting follow-up to on that particular topic of looking at sector weight over time.
See, I think looking at stocks would be better, like market cap ranks, total market cap in the top 10 or top 25. I usually look at like that because the problem is that they change the constituents, how they classify constituents all the time. So it's not like a static sector will have the same stocks in it or whatever. GICS has changed. Just in our career, we've seen like multiple changes in these index constituencies. So, but if you just look at the top biggest companies, I think we'll see similar numbers in past cycles, if I remember right. But it doesn't matter. To get back to your point, this is a problem, right? Well, not a problem, but this is a characteristic of indexing.
Exactly, and so that's one, and that's again maybe the most familiar to us. But then if you take the Dow Jones, which you mentioned, the Dow Jones is a price-weighted index. It's not even market cap weighted. It's just originally the companies, the Dow constituents, were weighted by their price. So the price goes up, and it behaves a little bit like a market cap weighting, but really price does not mean anything, right? You could be splitting, and you go from $250 to $25, and that means very little. They make adjustment for that, or you could maybe look at something like an equal weighted index. You can actually look at the S&P 500, and they calculate a benchmark that would give an equal weight to all 500 companies. So that's the S&P 500 equal weighted. So the smallest of the 500 would get the same weight as the largest on the other end. And if you look at that, you would get a completely very different return pattern and performance for the index, right? The same 500 companies, but if you just were to weigh them differently, you would get a very different weight. Equal weighted actually gives you a much smoother ride. You'd find it doesn't go up as much like in these rip-roaring bull market that we've seen, but it doesn't go down as much because you now have a much larger number of companies that contribute to your return. So again, hopefully we'll get to the topic of risk, but just that, again, construction, that weighting would have a huge impact on the risk and return profile of that benchmark.
This is so important, JP, because when we look at the hierarchy of what moves the needle in returns and risk, it's security selection is up there. But actually position sizing and timing is pretty important as well. And the position sizing is actually, if you look at it mathematically, the formula for contribution of return is your weight times your return is going to tell you how much it contributed to the portfolio. So, and that implies that basically what you own is just as important as to how much you own. So, depending on how an index is constructed, you have these big differences. And I was just had a conversation. What brought this all up is I've had conversations about benchmarking over the years a lot with clients, and we consistently see these kind of issues. And in fact, we're adding a protocol to our onboarding of new clients to really talk about how do you measure success and what we're looking at, so that there's a kind of an expectation understanding of how benchmarks work. I was looking at a client was looking at the NASDAQ. And this particular client was sitting at the 70-30 result, portfolio, 70% stock, 30% bonds. And if you look at it like over the last year, our 70-30 strategic benchmarks are, actually down, right, in the last year. And then if you look at the S&P, that number's up, the NASDAQ's up, right? So over the last year, but a blended portfolio would be down. So now this particular client was up on the year. But if we went to the concept of representativeness, it made a lot of sense, right? And then if we also went, the understanding of risk, and I'll let you talk about the risk here, but that's one of the primary reasons we look at these benchmarks is to actually have a risk target or risk range. So, I mean, what did you want to talk about risk?
Well, risk is, there's, again, many ways of measuring risk, right? Because if you invest, so let's take the S&P 500 once again. So it is a fully invested equity benchmark, right? So it has it is going to have a standard deviation or a risk that is reflective of that. And it does not make any tactical decision. You mentioned like our decisions to sell stocks, or our decision, since we are being more tactical in our allocation, we may decide to, for example, get our foot off the pedal a little bit and pare back equity exposure, or choose maybe securities that are less risky, right? But from our standpoint, and since we apply, for example, more stringent risk management technique inside the portfolio, even in an equity portfolio, we would have a much lower downside, which is really, for us, we talk about objective. Our objective is to give you a smoother ride from an equity standpoint, and maintain the market. If we think about the drawdown, the amount of money you could lose if you were fully invested, if you just bought the S&P 500, you would have been down more than 50%. Several times in the past 20 years, in 2008 and 9, in 2000, 2001, and just 33% just year to date, right? Those are big drawdown that most investors are not willing to sit through, at least not the people that we talk to. So it is our goal to try to mitigate that, right? And when you do cut, that downside through risk management, you are getting a much different risk profile on that. So if you want to compare yourself to an index, you should be looking at a measure that takes that into account. And such a measure, if we want to use maybe more of a technical term, and we can describe it, is something like a Sharpe ratio, right? Which would basically say how much return per amount of risk that I'm taking am I getting with this investment? Mm-hmm. And that is the way we compare portfolios, to say, okay, is this portfolio better? We don't just look at return. We don't just look at risk. We look at how much return is this one portfolio giving me per unit of risk versus this other one.
Because
so that's
we
the
could
way
dial
to look
up.
at it.
Yeah, because we could dial up the return with the same amount of risk if we could maximize that Sharpe ratio. So, and this, the Sharpe ratio is a nice kind of easy way to look at it. Drawdown is really important as well, because that's kind of the pain index that you really feel when the markets go down. But trying to maximize return and being opportunistic, that's the name of the game. We just want to have some risk level that we're working within. Like, this is our risk parameter we're working in. Now let's try to hit the ball. So like right now, and I'm just kind of looking at our dashboard right now. If you look at our positions in the dynamic global. So, each one of these, we look relative to the S&P, so we could see how it's doing relative to that kind of a benchmark, because we know people are looking at that. And, we have some that are up, outperforming like by 28% since we bought it. We look at it like, since we bought it, how has it performed since we bought it? Some are down, some of them are down versus when we first bought it. Like US Bank has not performed. Mm-hmm. It's down since we started relative to the benchmark. We may be up in the position, like in Dollar General, we're actually up in the position, but it's underperformed the market by 7.89% as of right now. And then others have blown the benchmark away, like Pinduoduo is up 99% over the benchmark since 4/7/2020. So it's, all these measures are so important for us as a manager. We're really just trying to scale things back for investors to have a better experience. And I think one of the problems with the experience that people have with investments is that the time frame that you're looking at is so important. If you're looking at where was I when I was at my absolute high, or where was I versus January, you could go back at any point in time and have a very different experience. It's just like if you look at a rolling return over 12 months, for example, you could see it moving up and down and up and down above zero, but you have a total return of plus, right, over the longer term. So I just think people get in trouble because of this.
Yeah. So it's anchoring, right? So you anchor to these, headline numbers that you see every day that are everywhere. And again, hopefully, maybe we're giving some color as to how to look at performance, right? Even if your portfolio is dragging a little bit on the return versus these headlines, this is not the full story by any means. If you've done that with again a much lower amount of risk, drawdown, or however you measure risk, this is success, right? If you didn't have the stomach to sit through a 30% drawdown and we give you a 15% drawdown through that period, well, you can't have your cake and eat it too, right? That's kind of the thing. So if we cut the risk, hopefully we'll maintain the upside. But there is
well, if you don't cut the risk to the right level, the client does what just happened, and then that's going to probably cost 12 percentage points in performance just this year, and then you compound that in the future. It actually is a spreading function.
Mm-hmm.
So, and if you do that more than once, then that compounds that spreading function. It's really important to have your risk right, and then to just, it's like that concept of the cyclist. There's a concept of cycling where the way that you maximize your distance per unit of effort is to keep constant pressure. When you're going uphill, you keep it at a constant level. When you go downhill, you still keep it at a constant level. You actually literally go further with less effort. And that's kind of what we're doing with how we size. We have a volatility thing that kind of, it's got to be adaptable. So you want an anti-fragile system where you are basically stabilized. It's a stabilizing mechanism is what it is. And so we are able to pull something up or pull something down. And it's anti-fragile in that there's risk reduction, hard risk reduction if something happens that's unexpected, big downside. Super important to have that to be anti-fragile. If you have a system or a process where you're just fully invested like that, in fact, indexing to me is not anti-fragile at all. So you could have a situation where you're in like the Nikkei, where it went nowhere for over 2 decades if you index to the Nikkei. But anyhow, this is a great conversation, JP. What else do you have to say about benchmarking as we wrap this part of our conversation up?
Yeah, I mean, it is useful, right? We talked about it from more of a client perspective, which is what matters. But for us, it's also important to look at the benchmark to determine our bets and call it, your exposure is the fancy word for it, is to really understand, because we have different source of ideas, right? In our portfolios, you mentioned that we're not hardcore into one style. We have a lot of ways that stocks find their ways onto our watch list. Some of them may have value characteristics. Some of them may have growth, momentum. They may be new businesses with great new innovation. So all of these sources of ideas, and we basically build that portfolio and size those positions for their own merit, right? But then when you put that all up into a portfolio, you have to look at, okay, what does that look like? Do I end up with a huge bet in IT? Do I have like more IT stocks than even a benchmark like the 500? And if that's the case, then you have to ask yourself a question, which is, am I okay with that? So it could be there's an intended bet, right? Which is I made the decision to be investing in tech because I think it's the right place. That's a top-down type of decision. Or the other one is bottom up, which would be, well, it's kind of unintended. The chips falls where they may, and I can see what it is. But then I have to make a decision. Am I comfortable with those bets? And if I am, then that's fine. And if I'm not, then I can maybe dial it down. So for us, it's very useful to understand those bets, make sure that we don't have too much concentration into specific areas of the market. We can dive into companies here like drivers. If you realize, even you pick a bunch of companies that not random, and you realize that, well, they're all driven by the same drivers, whether it's unemployment or consumer spending and stuff. You're like, okay, that's actually a risk that's under the surface, right? So all of that benchmarking is also useful from a understanding the risk of a portfolio and properly diversifying those bets. So maybe that's an additional piece of the puzzle.
Yeah.
It's the way we use it. So
Benchmarking,
I used a lot of jargon. I'm sorry.
No, benchmarking is a necessary evil.
Yes.
I mean, so it's something you have to do, and in fact we do in the sizing. We're looking at that because it does affect things. You can have an absolute volatility target, or you can have a relative volatility target in your benchmarking. And we are using in the stocks, we're using more of a relative target. But there are some overall overlays on top of that that are more absolute. So it kind of works itself out. But anyhow,
today's a
this
great
is a
day. I mean, I'm looking at our portfolio. We're up 1.25% in our all equity portfolios. The market has been, teeter-tottering between pretty much flat today. So, again, this is a days that you like, where you have good risk protection, but yet you have great participation in the upside. So,
yeah, we're trying to capture. It's all about the upside.
Yeah,
we're just. I guess benchmarks just help us to limit when we do have those downdrafts, and it's inevitable. We all have them. Let's contain that to that investor's preference, right? So, but anyway, really cool. JP, thanks for this discussion on benchmarking. Hopefully, people got some ideas from this.
If you have any questions, just please talk to us.
All right, sounds good.